Well, one common cause of mispricing is overlooked signals. That is, the market not reacting to the signals that the company is sending. And those signals can be positive or negative, and sometimes you can find them at various points in the same company. A recent example of that is Ardent Leisure. Now, Ardent have a wonderful business in the United States called Main Event, which is family entertainment centres. It's got bowling, laser tag, mini golf, machines, so forth. And they're getting about a 30% ROA on that business, much higher than the rest of their business. And when we first discovered Ardent, they really weren't rolling those things out in any sort of aggressive way. And when analysts would ask them about what was going on at the company, were they going to really expand hard in the United States, they'd say things like, well, we'll wait and see. But at the same time, they flew the whole of the senior executive team, about a dozen people, of Main Event out to Australia in front of the board. Well, I call that an overlooked signal. Clearly, if they're going to go to the expense of bringing those guys out, they're very serious about what's going on in the United States. And so that was another tick in the box for us to help us make a decision that yes, that rollout was really going to go forward. And quite frankly, of course, the management couldn't help themselves. Much better return in that business than the rest of their business, right in their core area. Of course, it works both ways as well, and in Ardent we've seen the reverse happen. We've seen the managing director leave. Now, at the time, when Greg Shaw left, it was sort of painted that in some way he'd let the company down. It wasn't really explained properly. And of course, it was very strange because he was a guy that had taken the company through the depths of the GFC and survived and gone on to make the company thrive. And so 2 and 2 just didn't add up. As we see now, perhaps a year after he's gone, the share price is back down to an absolute low point. And we can see that there were deeper problems going on. Just because the company's not prepared to explain doesn't mean they're not shouting at you that there's something wrong. And that was a great example.
A couple I'd really call out is the market underestimating new growth opportunities for companies. Another one would be just forecasting error that we see come through the market often. Talking about growth, the market really does struggle when there's a new growth path that the company's opening up, be it a store rollout story, be it a new product launch. A great example of a new store rollout story, which we've seen the market underestimate and continue to underestimate, is Green Cross. Green Cross now, following the merger with Petbarn, is really a big retailer. What's great about this rollout story for the Petbarn rollout story is they're probably about halfway through it at the moment. Now, this company currently has circa 200 odd stores. They're targeting 350 stores. The other great thing about this store network is it's very young. Roughly half of their stores have only been around for less than 3 years. And what we know about these stores is they typically take 5 to 7 years to mature. So here's a company which we think is going to deliver 5-6% like-for-like sales growth for the foreseeable future, driven by the maturation of these stores. The ongoing store rollout will add more growth to the same store sales. And on top of that, you also have this great story of them, well, really cross-selling all the products and services they have, whether it be grooming and the vet, across the client, and basically just getting more money from all these people out there who thinks their pet's a baby. And as Green Cross often say, babies are only babies for a couple of years. Pets are babies for life. So they can see a lot of return from that. So the market, when it looks at that sort of growth, it doesn't want to extrapolate for too long high levels of growth, even though it's pretty obvious it's going to be the case. So this comes to the forecasting area. You see, the market will often put, say, 20% growth in this year, but then tail it off very quickly because they don't want to have that big number sitting out there blowing out their valuation. On the other side, the flip side, forecasting error, when you look at forecasts from almost anybody, you'll see a nice straight line progression of whatever it is, be it sales, be it margins or whatever. Look at the history of a company and it'll go all over the place. So obviously the future is going to be all over the place as well, but that's hard to predict. So people tend to just extrapolate current conditions into their forward earnings. One stock that we're shorted quite successfully was Myer. Myer for 20 years has not grown its absolute dollar amount of sales. It's been basically the same number for 20 years. Yet when we shorted the stock, the market was forecasting 5% sales growth to come through from Myer. And you looked at that and go, how's that possible? I haven't been able to do that for 20 years. What's changed? What's changed? Nothing's changed. It's gotten worse. You've got Topshop, you've got Zara, you've got all this competition coming into their space, let alone the online threat that's been percolating there for quite some time. So, it was pretty obvious to us that they were not going to grow their sales. And, why did analysts not do that? Because if they drop sales in a company on buy with the enormous fixed cost leverage it has, it decimates the earnings. What's happened? Sales has not come through. What's Myer done? It's constantly been downgrading its earnings for the last couple of years. So, sometimes these things feed on themselves and become self-fulfilling, but it's all about identifying at the outset what's the market assuming, what's our insight telling us that's wrong about that, and can we actually make money from it?